Good afternoon and welcome back to Markets Today. A couple of things happening in the global stage. For one, a hit on Saudi Arabia oil fields over the weekend has actually caused an erosion of about 5% of the global oil supply that is coming into the market. What that means is about 5 million barrels per day will no longer be available to the market, at least in the immediate short term. Now, the conversation is whether U.S. is able to actually produce and quickly cover this 5 million barrels per day from its existing oil production. Overnight, we've actually seen a 19% surge on oil prices. They're at about $62 to $63 a barrel. This is important for you if you're looking at Kenya. Kenya is a net importer of oil. The first impact that we expect to see if nothing corrects on the price is a current account erosion. We could potentially be worse off than we had been recording an improvement. The last number we have seen is 4.2% as a percentage of GDP, and that's a great improvement, at least from where we stand. There is an impact with that factor. The second thing we're looking out is to see how does this impact of oil actually carry through into inflation? Is it food inflation? Is it our pump prices? Is it anything else that is affected with regards to the CPI basket? And finally, what is the potential weakness that we should expect to see, if any, on the current exchange rate against the US dollar? Now, to discuss this and also to discuss current, fixed income assets as well as equity assets, what is the trading strategy for this week? Mr. Charles Ogutu, who's an economist at Genghis Capital, is our guest for the day, and he'll be taking us through this and other news. Charles, welcome. Churchill, sorry, apologies. Churchill Ogutu, welcome to the show.
Thank you, Binde.
All right, what do you make of what's happening over the weekend? We went to sleep, we were peaceful on Friday, then overnight.
Quite interesting, but I'm not surprised. We've been through a roller coaster in the last 9 months of the year, so that's not a surprise for us. But what I can say is, in terms of oil, it's just boils down to the dynamics of supply and demand. So, and what we are seeing, people have not really digested the impact of the drone attacks in Saudi Arabia. So Saudi Arabia is the second largest producer of oil on a daily basis. So what people are factoring in is not even a knee-jerk reaction, but just something of concerns of supply disruption. US came out saying that they'll try to plug in, but you're not sure what extent it'll be able to drive even the supply, to plug in the deficit that has occasioned from this disruption in Saudi Arabia.
Okay.
Of course, we know that at some point, if the price keeps on escalating higher and higher, it will reach a point, even some of the OPEC producers currently, they'll find it expensive even to produce their oil. So there are so many dynamics working out.
So it's just a wait and see. It's interesting when you talk about OPEC, because Russia has also come out and said there's no reason to worry, and they're actually averse to having an emergency OPEC meeting with regards to supply. So maybe that's something worth keeping tabs on.
Yeah, that's something worth keeping tabs on. And it was just last week when OPEC and other allies had their meetings, just came out with a communique just saying that they'll continue with their oil cuts, at least to support the price. So I think that communication from Russia is just trying to ease the markets.
Okay.
Yeah.
So heat supply and magically your prices go up.
Yeah,
but that said, Churchill, when we look at the Kenyan economy, we are net importers of oil. What is the possible impact? We've seen 15% to 19% price surge over the weekend up until now. What do you make of this?
If you look at what we import, the basket of the goods we import, fuel and its allied products account to around 14 to 17% on a monthly basis.
Okay.
So that's quite significant.
All right.
So
is this the largest? Is it in the top three? Would you have a sense?
Not the largest, but the second largest. It keeps on fluctuating. Keeps on fluctuating. Yeah.
Okay.
So we're looking between 14 to 17% on a monthly basis. So that's really quite insignificant.
Yes.
So, but the good thing in markets like Kenya and also some of the emerging market economies, they're quite insulated because of the regulator coming in to regulate the prices. So that's the good thing about us. It's not a sticker shock that a 19% is automatically translated the next day.
19% to the 14 to 17% basket.
Exactly. So that's the silver lining in our economy. But having said that, we are still looking at, because being a net importer, we can't discount that factor. So it will be quite detrimental to our economy in the long run if the prices keeps on going higher and higher. So it will have a knock of impact on the Kenyan economy through, of course, the fuel inflation and the second order effects also going to the food inflation and lastly to the headline inflation. So that's quite a concern for us.
Okay, so it's something that we certainly need to keep looking out to see what happens and what impact that could have. Is there any sense of current account deficit? Could it affect that? Could it affect the currency as of today?
Right now, I think it's too early to call.
Okay.
But let's look at the developments in the next 2 weeks, which will be quite solid, because at that point is when we can now be able to get some substantive review from the next regulators' fuel pump price review. It was just the other day that we just came off from the latest fuel pump price review beginning to yesterday. So the next one will be in a month's time. So it's still quite early to call.
You can see it's quite blissful to be a small open economy. But let's switch over at looking at markets. So I wanted us to start off by looking at the NSE 20 vis-a-vis other indices across sub-Saharan Africa. Our graphics team will put up for us chart number 1. What is your sense? What is happening in Kenya with regards to equities, and how does this compare to other markets that you're evaluating?
Well, broadly, the market still is, I could say that investors are still cherry picking in terms of where they are seeking the yields. Right now, there's still this risk of sentiments towards emerging markets, economies, and also the frontier markets where Kenya lies. So there's still a bit of some cherry picking across the board. But what we've been seeing, foreigners have been the ones driving the markets, as per what you earlier alluded to. Safaricom having some significant weighting in the overall index tends to sway the overall index, the overall index. So whenever some of the big blue chip stocks move, they tend to dictate the market. And what we saw last week, to be precise, is there was a bit of some sell-off activities in the top 5 counters in the Kenyan market. So those are the ones which dictated the decline that we saw. The
decline that we saw. Was this Barclays? Because there was a huge trade that went through Barclays. About 23 to 24 million shares were traded there.
Yeah. Barclays was also one of the biggest,
was one of the big ones.
Big ones, And of course, the usual Safaricom and the banks
were
also some of the ones which were heavily traded, but now on the sell-off side by the foreign investors.
Allow me to play devil's advocate. I'm looking at the news over the weekend and also looking at the data that you have put out for us, looking at the valuations. So valuation is a good metric when you're looking at how cheap or expensive the market is. So Nigeria is at 7 times and Kenya is at 11.1 times. Even as we're trying to figure out the potential impact of this oil price surge over the weekend on the economy of Kenya and Nigeria, because these are two different economies. If the surge increases Nigeria, it benefits them, at least at a fiscal element. If it increases and it stays at that element, it's worse for us. What has been the sentiment up until now? Are people favoring Nigeria, or what are they concerned about? And could this possibly mean that the same investors who've been putting money in Kenya will continue to sell off in favor of a country like Nigeria?
I think if you look on a case-to-case comparison between Nigeria and Kenya, you find that Nigeria is one of the is the biggest economy. It's not even one of the biggest. It's the biggest economy in African space. So you find that most of the foreigners tend to go towards the Nigerian market, and also the number of liquid stocks that are investable in the Nigerian market surpass even the stocks that are in the Kenyan market. So you find that there's a bit of some variety in the Nigerian market. The only risk that we are seeing in the Nigerian market is in terms of its currency. There was a bit of some last month when President Mohamed Buhari came out saying that the FX reserves should not be used for food imports. So there's a bit of some negative sentiments towards the currency. And of course...
Is that still the case today?
Yeah, it's still the case, because there was a bit of some controls on FX, Nigerian Naira. So those are some of the concerns that you're seeing from the foreign investors, mostly if they're looking at the Nigerian market. But broadly, find that there are some opportunities that are there in the Nigerian market. For the Kenyan case, it's a bit of, I call it investor fatigue, because you find that there's just limited to like 4 or 5 stocks. And you find that the index in terms of what's the benchmark index, the Morgan Stanley Composite Index for frontier markets, Kenya's allocation is around 5%, but now it's just trickling down to 4 or 5 blue chip stocks, which, I mean, most of these investors have already hold them. So
Oh,
there's
okay.
not
So
much.
your investable universe is very small.
It's very small, yeah.
And the investment case has not changed for the last 3 or 4 years.
Exactly.
Okay, so
Yeah.
investor fatigue. What needs to happen, Churchill, for this to change?
Well, number of things needs to be put in place, but this is not a silver bullet. But one of them is just to try and bring on board some other counters. What you've been seeing in the market is more of the listings. There's not been an active IPO for the last 5-6 years. So, I mean, it's even locally, there's a bit of some investor fatigue. So we just need some to deepen even the current market and bring on board some of the stocks so that you can now be able to have some variety.
Okay, yeah. Fantastic. That's very interesting. And I know you really do enjoy looking at fixed income markets. What is happening there? Is it an exciting time to be investing in government paper or not?
Right now, it's also the cloud of uncertainty has hit the fixed income markets. From a macro fiscal perspective, the uncertainty in regards to the finance bill. Remember that finance bill has the proposed repeal of the interest rate.
Yes.
We haven't seen anything in terms of a timeline as to when the finance bill will actually be debated, which is really a concern. We are already towards the tail end of the first quarter of the financial year, but there's no, at least as of today,
yes,
no indicators to when the finance bill will be discussed. What I have seen from the finance bill is that there's a bit of some open-endedness towards it in most of the sections to be put in place, apart from 3 sections in the finance bill which are set to come into effect 1st January 2020.
Okay.
But the rest of it is a bit open-ended, so it's up for debate. Unlike the previous finance bills, whereby most of the sections could come into effect in the 1st of July, the beginning of the financial year,
yes,
and then we used to have what is called the provisional collection of taxes,
okay,
which used to be a stopgap in case of some of the revenue-raising measures that had been proposed in the finance bill, at least to come in place before the finance bill has been debated.
Okay.
But right now that one was suspended, and now we even don't have any indicator as to when the timeline of the most sections has to come into place.
Oh, so it's a vague bill in a vague environment with no clarity.
Yes.
Does this consideration still hold that if September ends, the first quarter ends, and anything that's in the finance bill automatically becomes law? Is that a consideration that still holds?
I think it doesn't hold
okay,
as per now. Yeah,
it doesn't hold per now.
It doesn't hold as per now.
So we're in limbo, Churchill.
We're in limbo because mostly the concern is, if you look at the legislative process from the first reading and then the second reading and then the committee stage and then the final third reading, you find that mostly, if historical trends are anything to go by, there's like a month's difference between when the first reading it happens and then the second reading. Yeah.
And also from the second to the third reading is also another month?
Second to the third reading is like a difference of a week.
Okay.
But what we haven't seen, we haven't had the first reading, even from the, just looking at the order paper, it isn't appearing, at least as at in the morning today. I haven't seen it appearing at least in tomorrow's session or even Wednesday session. So that's really a concern for us.
So maybe October, November, and there is a delay, and there's a pertinent clause in this finance bill that touches on the economy, which is the amendment to the Banking Act.
Yes, so the amendment to the Banking Act is now separate, because what's on the finance bill is now the repeal of the interest rate.
Okay.
But separately, there was the Banking Amendment Bill, which was now coming in to clarify the ambiguities that was there in the current interest rate cap.
So is this the same section? So the finance bill, does it say repeal the section on interest rate cap in the banking bill,
yes,
which is the same one that was being conversed last week by the MPs?
Exactly. So there are two different things. But from the discussions that we had last week, we didn't even hear any more of consensus towards a repeal of the interest rate. By and large, you found that the people who were debating were towards at least clarifying on the ambiguities. A few were towards the repeal, but by and large, majority were towards
just to clear the ambiguities.
Clear the ambiguities,
wow.
Yeah. Of course, there could be a bit of in the committee stage, somebody can just come in and try to repeal it from there, but it's still a huge grey area.
It's a grey area, Churchill. I actually watched it for 3 hours. It felt like a very long, interesting African movie. But my point is this: towards the end of the session, this was my take. So it felt like the MPs were actually pushing for an amendment to the Banking Act, and if they were able to go through this, the third third reading, the committee stage and the third reading and get a presidential assent to the amendments that they're pushing, which they're pushing aggressively, then that could potentially thwart what the finance bill is seeking to repeal.
Exactly, because if you look at it, it doesn't even add up for a group to come all the way to debate on a particular section, and yet the finance bill comes to repeal that section.
Exactly. The question is, what are you repealing? So it looks like everybody has an angle that they're pushing.
Yes. So by and large, I don't see that repeal as proposed in the finance bill going through, based on the discussions that we've seen. And that's something that's also bringing a bit of some uncertainties in the fixed income market, because you find that what's happening in terms of the repeal, in as much as there's this uncertainty as to when the finance bill will come in place, people are still considering that what if in the finance bill it's either repeal, it's still a long shot for it to be repealed, or there's a modification as proposed in the finance bill. That what if, which is just bringing some tension in the markets, because you find that all these papers, they're just based on the yields. If there's a modification, if there's a repeal,
then you don't want your money caught out. Okay, would that explain what we've been saying? Because at least in the last auction, there was demand for the 91-day paper, T-bill, and there was also demand for the 364, but absolutely no demand for the 182. And in the auction before that, there was demand for the 364, the 1 year, but no demand for the 3 months or the 6 month paper. Would that explain this uncertainty? People not too sure if they want to book their money in at very low yields before this decision on the finance bill comes out? Yeah,
exactly. People will rather play short term now, the 91-day T-bill. On the 364-day, they'll just try to play. Treasury has, CBK has been quite aggressive in terms of if you look at the last 2 months, the yields on the 364-day has been rising, so there's a bit of some aggressiveness in terms of even CBK trying to mop up liquidity. So they have allowed the rates on the 364-day tenor to slightly rise, and then they're accepting bids on the lower tenors, the 91-day and the 182-day T-bill. So there's a bit of some...
They're managing the process.
In a way.
And when you're talking about mopping up liquidity, what is driving this? And really, what does it mean when the government mops up liquidity?
It means if there's deemed to be higher liquidity held by the banks in the system. So, CBK occasionally intervenes to try to balance that liquidity, to have a balanced liquidity, what they deem fit as it is. And what we've seen in the last 2 weeks, CBK has been aggressively coming in the market to mop liquidity. Last week we saw on average the weighted average repo rate for the 7-day was around 8.6%. So
is this high? Is this low?
It's quite high if you compare with the 91-day T-bill and 182-day T-bill.
That's a very interesting reference.
Tier 1 bank, the large banks, if you are holding excess liquidity, it's a no-brainer. You'd rather just go into the repo market rather than financing tier 2 or tier 3.
So then you'd actually not see it coming through the auctions. So, but Churchill, where is this liquidity coming from? Is there any correlation with the demonetization process that CBK is spearheading?
I think it's something that has a number of factors. We've seen a bit of, because you find that the repo maturities are 7 days, 14 days, so they keep on maturing every now and then. So you find that excess cash, because there's not much supply or appetite in taking up the short, the bonds in the long, short ends of the yield curve, you find that there's a bit of some excess cash. Banks are still sitting on excess cash.
So it's more rolling over.
Exactly.
It's more rolling at 8.6. Can I do the repo rate as an individual in Kenya?
Of course not, because it's
But that's unfair, Churchill. But anyway, this is unfair. But let's take a quick break. The Nairobi Securities Exchange has closed. Look out for the closing bell.